So thanks for watching our podcast. This is the second in a series that we are running with colleagues across the Cresa network, looking at themes and trends that are emerging off the back of hopefully an exiting pandemic crisis in different phases of that kind of process at the moment. But each of us in our markets have witnessed and continue to witness disruption, but also opportunity. So looking at this through the tenant's lens, this is an opportunity for us to share some insights from what we're seeing and what we're hearing from clients, but also perhaps give some thoughts at what might be coming down the track, because in many different ways, this is far from over, and perhaps all we've got to is the end of the beginning for a number of markets. When I look at London and the way that market's evolved, the speed with which landlords have reacted has actually been relatively impressive, trying to meet the flexibility offered by what is a pretty significant and wide-ranging serviced office offer with something of their own version, which breaks some of the traditional leasing molds, which certainly in the UK market is something that we've always struggled to get landlords to perhaps move on, has probably been one of the biggest changes. But obviously there's a lot going on, and I'm sure each one of us on these calls has our own stories and war stories to tell from what we're seeing with clients. But anyone want to go first with some of the trends and things that they're seeing emerge?
Well, here in Hong Kong and China, Chris, we've seen landlords become extremely flexible and more aggressive in any transaction. We have seen an uptick in demand and people making decisions, originally Q4 2020 from China, and now filtering into this last quarter in Hong Kong. You're seeing transaction flow pick up, and demand is coming from local, established and multinational companies who have waited 6 to 12 months to make decisions, but now have decided to make them to take advantage of the market. And because the landlords have become way more flexible than they've been in the last 5 or 10 years.
Yes.
So
go ahead, Alan.
No, sure. No, so not as robust as what Dick mentioned, but I think Chicago, I think a lot of the major markets in the States are starting to plan for a return to office, either after the Memorial Day holiday here in a month, or more, I think, after Labor Day. Allow for summer where kids are still out of school, but really planning for a return to office. The vaccines seem to be getting rolled out. Numbers are stable. I think there's optimism. I think there's a realization that people need to come back into the office and be together for all the reasons we've been talking about: collaboration, culture, training, and so forth. So, and landlords, and one of the things Dick said, the landlords who are being flexible are the ones that are getting the attention. Ones that seem to still be rigid on lease term and their deal parameters, I think are just going to have a harder time.
Charles, you were going to say something.
Yeah, no. I was going to pick up on the market and what Dick was saying. What we're seeing in Western Europe, and if I took France, which of course is where I'm based in Paris, as an example, we're seeing kind of two markets. There's a market that has not been really impacted, which is the central business district of Paris. The vacancy rate was very, very low. It was around 1.5% pre-COVID. It's picked up to 4% today. So there's still it's still unbalanced and in favor of the landlords, in fact. So the rents are not diminishing. They're even increasing, because the prime rent in Q1 2021 is 50 euros per square meter, more expensive than what it was in Q4 2020. So the rents are increasing in the CBD, good quality buildings, very accessible, very looked for by corporate clients. So the CBD market, prime rents are expanding. Everywhere else, we're seeing flexibility. We're seeing landlords that are understanding that things are not going the right way. And we're seeing incentives that have gone from 10% up to 30% difference between quoting rent and net economics. So we have kind of a dual type of system here. CBD buildings still very looked for, and elsewhere the market has been impacted for sure.
Central Eastern Europe, where we still are under severe, strict restrictions. Shopping centers, restaurants, hotels are closed, and we probably will see some openings with the beginning of June. Vaccination is being implemented, but then again, as most of the European countries, we have limitations with supply. So the willingness to vaccinate is we don't have enough vaccines. What we see from the statistics is that we should be all vaccinated by end of August, and the return to sort of regular business should kickstart with schools in September. Business-wise, most of the offices are 50% occupied by the tenants or their staff. Still, home office and remote work is pretty widely implemented. Landlords are becoming very flexible in terms of existing rents and renewals. We don't see drop in demand from the existing stock. There is a big number of tenants which are debating what to do next and how much space and workforce they will require once the recovery is fully implemented. Industrial, very strong. Manufacturing, very strong. Construction, booming, very strong. As across the globe, the concerns are with inflation, which is also being debated on the rent levels and so on. So we will still have 3 tough months ahead of us. Lovely summer, and business-wise, we're looking what will happen with in September.
Okay, that's interesting because Charles, you talked about vacancy and a really low vacancy rate actually in the CBD. I mean, we've got a significant increased supply in London, but actually when you really dig deep and look at what that supply really is made up of, a lot of the space is quite poor. And so if you have a search for quality space, the dynamics in London haven't really changed an awful lot, but the perception of how the dynamics should have changed is quite considerable. So in other words, there's a mismatch between what our clients are expecting and then what we're actually finding in the market. And that's quite difficult to manage. And we're even seeing now where space was put onto the market midway through last year, it's actually being taken off the market again. So whilst we had that huge dump of space during the course of last year, we could quite easily see that a lot of that disappear again as people realize that this kind of extraordinary thing called hybrid working that everyone seems to be talking about now isn't actually very different to what a lot of people were doing anyway. And those corporates who have, certainly in London anyway, reduced their footprint over the course of last year off the back of this are only really actioning things that they should have done 3, 4, 5, 6 years ago. It's not sort of new news. It's just COVID has given them permission to do those things earlier. Does that kind of resonate in your markets?
Yeah, Chris, one of the things, the management of expectations, the things that people are reading about, the subleases that are coming back on the market, the real value subleases, those are bigger pieces, right? If you're in the market for 50 to 100,000 square feet, there are options and you can really get that discounted value. If you're looking for high quality, smaller, in a strong class of building, it's not as what you'd think by what you read. And so it's a lot of managing expectations. Face rents have been held where landlords are trying to offset with concessions. But again, those are for tenants and those are limited that are still willing to currently make a long-term commitment to space. So I think a lot of it is there's just real estate fundamentals on these buildings that are held by institutional, grade ownerships, investment groups, and they're just the rents, what you'd think would be materially lower are not really shown to be. So that is a bit of teaching.
Yes, and this looks like kind of universal when we look at all three of our markets. Managing the expectations from managing directors within our clients is probably one of the most difficult tasks we have as we speak, because there's kind of this sentiment that every business is broke and space is vacant everywhere, and that there are boards again everywhere, and that there's full of possibilities that should be offered by the market for whichever client we're talking about, and explaining to these people, which are themselves decision makers within their companies, that it is not in fact what we are observing and what is happening is one of our toughest challenges as we find it, and it seems in the UK, in Western Europe, and in the States, as I understand as well. So it's a common theme that we have, which doesn't make our lives easy, but I guess because we're not young anymore, we've gone through these in the past, and we have kind of an experience to stay pretty pretty explanatory and have the good arguments, just to tell them, guys, that this is what's happening today. You have to listen to us and to understand that this is a fact, and you have to adapt it and adapt yourselves to what we're observing on our markets.
And how do you think that's going to play out in terms of what's your expectation for your markets? Because I think certainly for London, we look at it thinking actually, the bounce back could be as significant as the kind of notional collapse that occurred last year. I don't think we see that in terms of a spike in rents, but we certainly see it in an easing off of some of the hyper concessions, hyper incentives that have been out there the last few months, pointing us towards that whole strike while the iron's hot, make that move today, rather than waiting and waiting and waiting, hoping it's going to get better and better and better, because you could foresee a scenario where it could very, very quickly change. Is that happening in Hong Kong, Dick?
Yeah, I mean, there's definitely a flight to quality stock here, and landlords have been quicker than normal to react, and tenants have reacted in the last quarter to that quality stock because it has become more affordable. The Chinese economic figures are very strong. The Hong Kong IPO market has a big pipeline. So people and the press are stating it's going to come back. However, the quality stock will get the good tenants first, because those landlords are sophisticated, want to capture those tenants now, and will reduce on that basis to capture those tenants. I think the grade B is going to suffer, and is suffering at the moment.
Any thoughts on that, Piotr?
Well, we still have a lot of stock being constructed and to be delivered by end of this year. And what we see and where we participate, we have a pretty healthy take-up and demand. The challenge is among the tenants, how much they will grow. It is not if, but how much, and how much space they need to reserve for consolidation or for growth. But then again, the landlords are trying to capture the action and are forthcoming with various flexible solutions on rent-wise or terms.
Peter, I think, how you said it, there are companies in different stages. They, the great sort of reset that this has provided, where everyone is rethinking their people and space and how real estate impacts their bottom line, are taking this opportunity to rethink it. That, again, to call it a silver lining, it's just it's not like one size fits all. So I think companies, depending on where they were in the stage of their business, if they were, in a scale mode or stability, or if they were even looking to do something with their business and maybe start to pare back a bit, are looking at it differently. But they now have an opportunity to really be, thoughtful for how they come back online. And again, depending on where they are in a lease term or their business path.
Interesting. That's putting it in London. Certainly, it's putting a massive focus on ESG and that whole piece around the sustainability of product and the choices that they make being the right choices. Not just for their business and their people, but for their community and for the environment. And that's leading to a degree of increased obsolescence, enhanced obsolescence around some of the secondary stock that we have across the capital.
Has anyone seen an increase? I'm curious in their suburban or periphery submarkets. So that was one of the things at the onset. Everyone was talking about how the suburbs were going to see a real increase, and actually vacancies in the Chicago suburbs have only gone up. So this flight to the suburban core office markets, where we have 3 core suburban office markets, haven't seen the benefit, I guess, from companies moving back out.
Yeah, we've had some of the outer areas around central London have been busier, but not really busy, and there's not a huge amount of stock out there anyway, so it's quite difficult to capture it because and I fear that by the time someone creates the space, people will have mentally adjusted again and gone back to what they were doing before, or a version of it. The only real movement we've seen is IWG Regis actually starting a focus search now on building up some of their regional centres to create more space to allow people who don't have the comfort of being able to work from home long term an ability to go and do something that's close by in that sort of hub and spoke scenario. But we're not seeing as much as I expected, if I'm honest.
Yeah.
Yes, here in order to see this, there's only one suburb that has beneficiated from this. It's La Défense, our skyscraper part of Paris, where we have 40 million square feet of offices, and the only reason is that you have good public transportation to that part of town. You do have a quality offering with very high standard buildings and great amenities for rents that are between 50 and 75% lower than central Paris. So because you have good public transportation and good quality buildings, some clients are moving from the center of Paris to that part, but to that part only. All the other suburbs, Alan, to your point, are really suffering with vacancy rates that are just exploding. Whereas Paris, as I said earlier, is not too impacted at this stage.
We've seen on the serviced office providers, we have definitely seen landlords do joint ventures with those providers. Rather than doing it themselves, they've taken in the IWGs, the executive centres, and they're doing a profit share to shore up the vacancies within buildings. And they also go to their tenants who decide to leave and say, look, perhaps don't leave the building, come to our joint venture shared office offering as a backup within their buildings and portfolio.
And interestingly, as a lot of clients are sort of trying to work out exactly what the future looks like, reducing by a floor your leased space and relying on the ability to dive in and out of flex space within a building or an adjoining building is pretty compelling, isn't it, at the moment?
Absolutely.
Yeah, it's fascinating. So we just toured a substantial building in Chicago, and they're taking 2 floors, a big amount of space, and doing their own version of shared office. And they have a very significant, shared office provider also as a tenant in their building. So there's some crossover where that entity will maybe manage a part of the building space, but there is some of that internal competition, which is good for us and our clients, right? Options and competition. Yeah. So I think it is a part of every core asset.
Well, in Central Europe, we still observe relocation of shared services into this part of Europe for various reasons. But the market leader for the last 6 months, 9 months was industrial and logistics, due to the readjustment of supply chains from Asia, e-commerce booming, road infrastructure investments, deep sea ports being enlarged, and the whole e-commerce trade inflow in this part of Europe is motivating very large investors and developers to invest in the stock. So we see a massive boom in that sector across this part of Europe.
Interesting. Peter and others, what are you seeing in construction costs for, and let's just focus, I guess, on interior, which again, we saw for the first 6-8 months, you were having such limited work, general contractors, and there was real value, but now the price of materials seems to be, increasing, and
well, we see the price of construction materials are skyrocketing. Cost of steel 100% up, concrete and finishing materials. That's a challenge, and that is on top of a very dynamic residential development. So massive demand for building materials is creating the price rises. But I think this is not only Central Eastern Europe, but also other parts around the world which are observing the rises.
Yeah, we have the same issue, and only slight differences. We've erected some borders around ourselves as well. So we have price increases, and we have delays as well, which inherently are costly to manage. So that hasn't been massively helpful.
The other thing we've seen here in Hong Kong is it's now competing against Singapore, Shanghai for Asian headquarters. So it's trying to bring in fintech incentives, tax incentives, lower business rates for companies and multinationals. So all of the COVID pandemic has redesigning what governments can do to bring these companies back in or make them stay here for other reasons, perhaps in Hong Kong, but it's really made the government focus on how it can benefit businesses going forward. And there's a big focus point going on that going forward.
And Dick, without wanting to be controversial, far be it from me,
no problem.
I mean, you've got some pretty significant geopolitical things going on at the moment.
Sure.
Has that impacted global companies and their views around Hong Kong as a location? Have you noticed any of that anecdotally?
Yeah, definitely the TMT companies that are in the internet, fast tech space, they are thinking, is Hong Kong the right place, or is Singapore a better solution? The costs are higher here, but they've just become lower due to COVID. So it's definitely impacted Hong Kong and multinationals' thoughts on the city as a HQ area. And perhaps the winners for those headquarters to spread out in Asia will be Singapore and Sydney, just so people can spread their risk in the region.
Cool. Well, look, I think that's probably naturally on that high note brings us to a logical pause, given that we've talked quite a while and people have got to listen to this, hopefully. As ever, thank you for your time. It's an honor and a privilege for me to have so many wise people in one little webinar. I appreciate it, and I appreciate your time, different times of the day, level of commitment and all that. And I'm sure we will meet again in the not too distant future to talk about the next stage. And maybe, Piotr, by then you would have been able to go to a restaurant and really enjoy the summer.
I do hope so.
Yeah. But until then, thank you guys. And thank you for watching. And if there's anything that any of us can help you with regarding real estate, then do please get in touch. Thanks.
Thank you.
Thank you, Chris.
Thank you,
everyone. Bye-bye.
Well done.